Stay tuned for a content-filled episode. We got silver breaking $49 an ounce and on the way to that $50 an ounce mark. We also are going to talk about the 2009 Libertad and touch upon the AI bubble, and I'll show you where it looks like I've identified the point where the smart money transitioned from the AI sphere to the gold precious metals.
Ladies and gentlemen, your host, Titty Hunter.
Today was a very, very exciting day for those keeping their eyes on silver and on gold and on silver and gold miners. You got a lot of miners that gains of over 10% on the day. You had silver crack through 49 on the way to 50. We got gold just smashing through 4,000. So really exciting times. What I do want to iterate about today's episode, and every time I do one of these videos and I upload them to YouTube, within the first hour, I always try to make sure I start adding in the timestamps so everyone can kind of go and fast forward to the specific content that they want to see me highlight. And so, for example, like I'm going to touch upon the AI bubble, and some folks want to be like, "Hey, Titty, man, like I don't want to hear this like AI bullshit, man. Like talk about Libertad." So, you'll have the ability just to skip the whole AI conversation, but I really just started doing my due diligence in terms of getting in on the short side on what I do believe is an AI bubble. And I talked about it last time because as a statistician and being there firsthand, I'm hearing the hype on the daily basis. When after a couple of times you hear this story that the secretary in the office is going to a vibe code and put together some automation, some agent or something, that just stinks of BS to me. And I mean, just the fact that I have that direct line of sight and it's pretty clear to me what I'm seeing, it makes me able to do some due diligence on the business side of AI. And I started to understand what's going on in that sphere and why I think it's a bubble. So just to clarify right off the bat, this is just for informational, educational purposes. This is not investment advice. You should seek that from a professional. I mean, to be quite honest with you, I initiated a short position on NVIDIA this week. And I mean, I'm talking about leap options. Leap options are essentially long-term options that expire over a year out. And I mean, I just nibbled on them because I'm just getting started. This is very raw due diligence, back of the napkin type of calculations that I did here. So, I mean, take it with a grain of salt. But being, as I mentioned, that I've been in the world of machine learning /I, and I kind of boots on the ground type of experience, and I see what's going on. And I'm not here to say, AI is trash. I'm not taking the complete opposite side of hype. Like, it has its uses. Like, if you're a hedge fund and all you care about is pure, raw, predictive power and explainability of the business, having to kind of anchor the explainability to some levers of things that can be controlled in the business, if that's no matter to you, just pure, raw profitability as like a hedge fund, then getting that extra lift, a 1% lift on a model, 2% lift on a model that you might get with a very intensive iterative model that takes a long time to run, then yeah, that 1% equals a whole lot of dollars. But on a regular business where then you have to be able to interpret the mathematics of it and kind of quantify, like this is this lever, this is that lever, and you have to establish guardrails. So the data itself has to be constrained within it has to be level set with the business and how it runs and not go out of bounds and try to model something that's not even in scope. And so from that aspect, I said, I feel just the hype and the way it's talked about. It's a bubble to me. And some of the stuff that was being shown on CNBC and the other financial media, it drew my attention. And I was like, let me look into it. Let me see what's going on. And that's what I wanted to talk about here inside the looming AI bubble. This one I didn't see on like CNBC or anything. This was actually, I saw somewhere in Twitter. Somebody pointed this out, and I was like, "Whoa! Like, is this deja vu?" So Enron was removed from the S&P 500 on November 30th, 2001, after it collapsed and filed for bankruptcy. Nvidia was added to the S&P on that same date, taking Enron's spot. So that was like, wow! I can't believe that. So again, this is really just raw due diligence, not thorough. Some of the calculations I'm going to be showing shortly, kind of back of the napkin calculation. So absolutely take it with a grain of salt. But this is where my mental workflow is around. And so I started looking into how NVIDIA actually runs its business. This is really the first time where I was like, I'm actually curious to see what's going on, how exactly this bubble can pop. And NVIDIA, what I saw, they kind of essentially finance the buyers of their chips, whether they're buying the chips or they're leasing the chips from them. And so think of like when you go to buy a car and and you finance it through them. Well, they're lending you the money to purchase that car, and then you make payments to pay off the car over a sequence of years. But the thing that also stood out to me is then you can say, okay, I'm going to use the chips as collateral and purchase more chips. So just imagine we're allowed to borrow from one of these dealership finance companies and say, okay, I'm going to buy that car. And then you know what? I'm going to take that car and it's going to count as collateral. Let me buy another car. So that was a little startling just to be reading up on that. So here's how it works, kind of like step by step, what you're seeing in front of you. NVIDIA, they fund AI startups. You think of like OpenAI, Lambda, and dozens others through basically loans or equity. Then those startups, they take the money and they spend it right back on NVIDIA hardware, the GPUs and the servers. What's the twist? Though, like I said, those same GPUs are often used as loan collateral. Their supposed resale value props up even more borrowing. So this starts getting into a vicious cycle. Then, Wall Street, they love to monetize everything. They love to turn everything into some type of financial instrument. So they get into the action. They start issuing debt backed by those GPUs, which we're going to talk about, they're depreciating assets. Kind of like you buy a car and you take it off the lot, it is depreciating. And it is the same thing with chips. And then ultimately we got the GPU demand. It keeps soaring. The valuations inflate, credit expands, and the loop reinforces itself. Everything looks great until the collateral at some point starts losing value. And if it sounds familiar, it should, because back around 2000, Lucent Technologies did almost the same thing, financing telecom startups who used that money to buy Lucent gear. In Lucent's own 2000 annual report, what I'm quoting down there at the bottom of the screen, they bragged, as the optical and mobile internet unfolds, Lucent is poised to light the way. A year later, the lights went out. So again, just a word of caution, these are just what you're seeing on this slide, just back of the envelope calculation. So essentially take it with a grain of salt. This is just beginner's due diligence. I'll reiterate again, I started a short position via Leap put options, but I'm talking about I just started, so it's less than $300. I do have plans to scale that up, but for the time being, I'm riding it on call options and miners on the equity side, on the leverage equity side, as opposed to being so focused on this. But this has been drawing my attention, and here's just an example, a mocked up example of $100 billion circular finance GPU system. And it's kind of like what's forming today around the AI hardware. You think of it like a financial echo chamber where you got the same chips. They show up on multiple balance sheets. They're sold, leased, financed, recollateralized. And then, when things start to wobble and losses cascade, we're going to have problems. So let's walk through it. First piece, the first domino in the process is sort of like, before these chips ever generate a single dollar of real revenue, they're already losing value. This is where I talked about it when I talk about depreciation. Technology moves fast. The average GPU loses 60% of its resale value within a year or two. In this example here, we're talking about a $60 billion paper loss right out of the gate. No one's defaulted yet, but the collateral everyone is building the leverage on, it's already shrinking. The next piece is the utilization shock. This is this is the required step to start shaking things up, kind of like the demand softens and things start falling. You think of like a data center, they get demand for processing in their data center and usage of their chips. If it were to go down, let's say 10%, or if they're renting it out, the rental rates fall 20%. You could estimate, maybe this is like a $12 billion revenue shortfall. And then those who financed that hardware, they leased the funds, these hosting companies, they're going to start feeling it first. And then the cash flows that were supposed to service the debt, they're getting squeezed because data center hours are down. Next is the counterparty risk, and the credit chain, they start to have cracks. All it takes is a couple of defaults to start. Let's say you got 5% of the leases on these chips go bad, and the lenders, they recover about 40%. Let's say that we're going to just estimate, this is a back of the envelope estimation, 40% of that value. That's another $3 billion impairment. But the real issue isn't the amount, but it's then, we're switching on the lever of more precisely said, switching off the lever of confidence. And so if counterparties realize that these losses are not going to be isolated, credit is going to tighten across the whole chip ecosystem. And then what starts to happen? You start having fire sales, forced liquidation, it pushes prices lower, and then you have a big flush. Some of the players, they're going to need cash. They'll start dumping these chips on the secondary market, already depreciating chips. And then prices, let's say, fall another 20%. If we ultimately trigger mark to market where they have to write down these losses, we're going to estimate that back of the envelope, 10 billion. And these lower prices just force more sales, and that just drives prices lower. So the estimate here on an estimated system here of $100 billion, they're going to lose 85 billion as these dominoes all add up. So we got depreciation, weaker utilization, defaults, and fire sales. And this is not because anyone did any type of fraud outright, but because basically what was happening is they were leveraging these same assets, double counting across too many balance sheets. And then the day one domino falls, that's when we're going to start to see losses amplified. So here's why this loop really matters. Basically, the same GPUs, this same hardware, it's sitting behind multiple balance sheets. That means when they lose value, those losses are not going to cancel each other out in any way. They're going to stack. They're going to add up. Think about that. One chip counted as an asset on 3 or 4 different spots, and that depreciates. Every one of those books takes a hit. So we just talked about the sequence. Depreciation, the utilization falls, counterparties start cracking, and liquidation starts widening. And I mean, this is exactly what happened with Nortel and Lucent back in 2000. They financed their own demand, the assets aged, customers started defaulting, and the accounting cleanup came at the end. And, the one stat that startled me where I'm like, wow, was basically capital expenditures, CapEx on AI has added more to GDP in the US than consumer spending. That's how inflated this boom has become. Capital expenditure on servers and chips is outpacing what households spend in the real economy. And I have the quote there at the bottom, just reminiscing of the tech bubble. Bernie Evers of WorldCom, he said right before his empire collapsed right in front of him, we have the right assets for a fast-growing digital business. It sounded visionary then, and it's starting to sound familiar now, doesn't it? So if you skipped that part of the video, cool, no worries. You're probably like, yo, Titty, I don't give a damn about the AI bubble. I'm here for silver, and I'm here to see some titty coins. Uh, but I think this one is worth sticking around for. I basically was analyzing the chart, trying to say, has there been any meaningful distribution of smart money slowly leaving the market? And I did see an indication of that beginning in 2024. And what was very interesting is, and I'll talk about it shortly, it's not my idea. There's someone I kind of used the term and that drew my attention to how to explain what I saw here, but it's the concept of capital rotation. Basically, specifically in this case, was big money, smart money, rotating their capital, their cash out of AI stocks like Nvidia and into gold and precious metals and miners. So what I have here, I've mentioned in the past that I don't like looking at daily charts for stocks. I don't like weekly charts. I start to get interested with monthly charts and quarterly charts. And why? Because on a monthly chart and a quarterly chart, all these daily shenanigans, because they got a guy from the Fed to speak at a conference, or there's a jobs report that comes out, or some of these little mini daily shocks that pop up. They kind of start to filter them out. They're kind of just like noise, and you start to see the bigger pattern, the bigger picture when you look at monthly and quarterly charts. And this one is Nvidia's quarterly chart. I got it going back to about 2015. But what I want you to focus here is on the 2024. This would be the quarterly. So it's 3 months. Each of these candles. This is a candlestick chart essentially showing, when did the price open up at the start of that quarter, the April 2024, and where did it close at? If it is green, that means the closing price for that quarter is above what the starting price was. And then what they call these wicks is basically the full range of price that the stock traded at during that quarter. And if you read enough about these candlestick charts, what folks will begin to tell you, and in the case here of what I call distribution, what I'm identifying as that, smart money was distributing, meaning they were selling out of these positions, was the wicks predominantly on the top of these candles. So basically, price shot up above what it ended up closing at for the quarter, but it ultimately closed down here. This one, the wick is more predominant on the bottom, but the next 2 quarters, going in basically at the end of 2024 into the beginning of 2025, the wicks are on the top side. When you see this, it's indicative of distribution, that the prices were bought up here during the quarter, but ultimately there was selling pressure, so the prices closed down here. So huge range, but ultimately the selling pressure made it end up for the quarter down here. And so what is indicative, if we say these wicks here, the 424 wick all through the January 2025 wick, if we're saying there's distribution here, okay, interesting. But now let's bring up GLD's chart, quarterly chart. So if we start looking around that same time frame, that 424, well, would you look at that? That's coinciding with the breakout in gold that started on that quarter, and it's been a sustained quarterly breakout. Look how many green quarterly candles we have. So this is evidence. Obviously, it's not concrete. I'm not thinking about like concrete evidence, like I could prove this in the court of law or anything like that. But it is indicative that we had distribution on the Nvidia side, these big wicks on a quarterly chart. So it's not noise. And then it coincides, the wicks coincide with 424, and GLD's breaking out into new all-time highs. And so what I just talked about in those 2 charts showing you Nvidia and GLD is what's called capital rotation. I mean, it's not a unique term to anyone per se. It's been a term used in the markets for a very long time. But it drew my attention because this guy I'm following on Twitter, I followed him for many years, even before he was on Twitter. He was on one of these message board type websites. It was called Gold Tent Oasis, and so we're talking over a decade ago. Basically, the premise of the investment thesis of a secular gold and silver market, I kind of shared that with him, and he was a meteorologist by trade, and he's kind of like applying pattern recognition to the charts and kind of predicting where gold and silver would go. And so many years ago, and I was accumulating little by little back in those days, and I was following this guy before he now has a website, charges for his services, but honestly, I don't subscribe because what need do I have to? I understand his methodology since day one, and he has been talking for a while now, for quite a bit of time, about the capital rotation. The capital rotation, not only of just AI stocks, but tech stocks and all stocks in general, into gold, into silver, into precious metals miners. So, highly advise you take a look at his Twitter feed, read through his posts. He posts a lot, is continually updating his charts, and he provides a lot of great information. But that term I used of capital rotation, it just sparked, it triggered that this guy Northstar has been talking about it for quite a bit of time. Some of you may have skipped up to this part, kind of said, screw the AI bubble, screw capital rotation. Titty, let's talk about that 2009 Libertad, because that's what I'm here for. And so this is where we start talking about the 2009 Libertad. It is not a scarce one relative to Libertads itself for the 1 ouncers. It's way down here at the bottom at over 1.5 million. It's 1.65 million mintage near the absolute bottom. It's worth noting again, we don't have any kind of full audit. It's kind of opaque in terms of the visibility when we start to go into these high mintages, because, like 1985 makes sense. We see so many 1985 Libertads on the market. They're everywhere. They're so easy to find. But allegedly when we went over the 1992 in that video, we said, there's almost 2.5 million mintage on that. But heck, the market prices don't support that. The market prices are actually higher than the 1985s. That kind of doesn't make sense. And so a lot of people speculate, a lot of these years, depending on price dynamics and depending on whatever else, and there's been proof for other Mexican coins, they actually end up melting coins, and they don't actually document that anywhere. We do not have line of sight into that type of activity. So when you start seeing these high mintages and looking at market prices, you kind of start assessing, it's allegedly almost 2.5 million, but the price doesn't say so. And so we're starting to be at this very extreme end. 2009 is the 4th highest in mintage, but we'll talk about eBay comps later in this video. Let's take a look at the NGC and PCGS graded coin populations. And first, I got to tell you, I don't know what NGC has done. I think this was about 2 weeks ago it happened or so. They once a week, they do an update to the population numbers, because coins are getting graded on the daily. And then, once a week, they update the population numbers and the grades. And so in one of these recent updates in the last couple of weeks, they severely messed up this 1 UNTHA distribution. The years are not in order. It's chaotic. You got 2021 before 1982. I don't know who the heck butchered this website. Shame on you, NGC. You got to do better. So this is what I ended up doing. I couldn't find 2009. I clicked on this filters thing and I just said, 2009 to 2009. And that's why you're seeing on this view the 2009 1 ounce silver Libertad and the 1 ounce gold Libertad. You see them both here on the screen because I had to filter. I couldn't find the damn year. But here we are. 2009 on the 1 ounce silver, 672 graded so far. And we do have top pop of 70s. There are 3 70s out there. This is the NGC side. PCGS side, who still maintains a nice and clean population report and everything's in order. You got 775 total graded with 670s. So that's kind of how things stack up on the population report. I did want to highlight on the NGC side, historically, what's happened since I started very formally collecting this series. So I pulled up an old post 7 months ago. I talked about the 2009 Libertad. You could go on the Libertad coins, find me and look at my old posts. And I kind of talked about, the populations. So in 2021, there was only 220 of them graded at NGC. When I kind of jotted down that snapshot. In 2023, that number was up to 312. And 7 months ago, it was up to 649. And now we are at 672. So that's kind of been the trend of how many coins have been submitted to NGC to get graded for the 2009 since 2021. Let's talk about eBay sold comps for the 2009. So I got my completed listings and my sold listings filters turned on that I selected from the left pane. Something to think about, because I talked about this in the past, and it's going to get tricky with silver price really surging in the short term. I told you that a lot of times auctions get canceled, and the cancellation doesn't automatically happen like within a day. I have seen it take up to like 7-8 days for the cancellation to vanish. So basically what happens is, whether it's due to shill bidding or a true request for a cancellation that's true to the heart, you will have a sold comp. And today is this was October 7th. That was yesterday. There was one that sold at $63. But I'm bringing this up not only because price of silver is surging, but because I'm seeing these for the 2025s that are auctioning for barbaric prices. And what I have seen is that, I've seen a sold for a low number, and then it sticks, and then like 7 days later it vanishes. So that's pretty indicative that people are playing games. Very specifically, not only in the 2025, that's the one that's kind of drawn the attention, but it happens for other year coins. But I would say 2009 is not a year that it's going to happen for, but the more scarce varietals, the 91 Type 2, the 1998, the 99, the 97, those years, you could see those types of games get played. But at the same time, it's going to get interesting even for the common dates, because you have spot silver. We are now in a phase, kind of like a waking up from a slumber phase, and prices are really taking off. So the comps are really going to change fast with this type of price action. But nevertheless, let's see what's happened recently. You have a 2009 here from yesterday, bidded up to $63. This looks like a buy it now from APMEX that went through at $74.15. That was on the 6th. On October 5th, one went for $59.99, but price has been going up, but that one is quite ugly. It has a whole lot of milk spotting on it. Here you have one with like a mix of milk spotting and toning. That one went for $60 on October 5th. On October 4th, you have one here. Oh, this one is cleaned for sure. I mean, I would not be bidding 58 on this. This thing looks like somebody put a Brillo pad to it. You take a look at that picture. If you zoom in, you'll see those scratches even more, going all in the same direction, you could tell. And then October 3rd, $53 and so forth. So we kind of have an idea of what the comps have been going for a very common year like the 2009 Silver Libertad.
Click that subscribe button for more data-driven coin analysis.